Welcome back to the Wall Street Podcast. Today we're digging into a Nomura Global Markets Research Report. It's titled Second Share Placement in 6 Months, and it dropped on September 11th, 2025. It focuses pretty tightly on NIO Inc. and their latest equity offering. Our goal here is to really distill the critical financial moves and the strategic thinking behind them for NIO. Give you that rapid, informed take. Okay, let's jump right in. NIO announced their second equity offering of 2025 on September 10th. Just before the U.S. market opened. The plan is to issue up to 181.8 million Class A shares, or American Depository Shares, ADSs, as we usually call them.
Right, the U.S. traded ones.
Exactly. And there's an over-allotment option, too. Another 15% potentially. That's about 27.3 million ADS.
So potentially bringing the total new shares to around 209 million.
That's right, which translates to an estimated 7.5% to 8.6% dilution for current shareholders.
So insignificant in the pricing.
Set at USD 5.57 per ADS,
Yep.
or HKD 43.36 per Class A share. They expect to raise between CNY 7.2 and 8.3 billion from this.
So the big question is why now? What's the driver for this quite substantial raise? Well, Nomura highlights a few key things. First, funding essential R&D, new tech, new models, and also expanding their battery swapping and charging network. That's always been core to NIO. But critically, it's also about shoring up the balance sheet. They actually slipped into a total shareholders deficit in the first quarter of 2025.
A deficit meaning liabilities exceeded assets.
Precisely. Which is, well, a significant red flag. By the end of Q2, it stood at negative CNY 12,206 million. And remember, this follows that previous capital raise back in April, around CNY 3.7 billion, which clearly wasn't quite enough.
Right.
Despite that deficit, Nomura actually calls this good placement timing. They see business potentially improving from Q3 onwards. Plus, NIO is aiming for non-GAAP break-even in Q4.
That's operating break-even before certain adjustments.
Exactly. And there have been some recent positives, like the Onvo L90 deliveries looking solid and a decent outlook for the new ES8.
Okay, Nomura sees good timing, but this is the second placement this year. A 7.5% to 8.6% dilution, it makes you ask. What does this recurring need for pretty significant capital injections tell us about NIO's cash burn? And, well, the longer-term picture for shareholder value.
Well, it starkly highlights the aggressive capital consumption, doesn't it? This kind of continuous equity financing suggests operational losses are still substantial. They simply need external funding to keep the R&D engine running and expand that network, especially, as we mentioned, to tackle that shareholders deficit.
So it's a constant balancing act.
It really is. It forces investors to constantly weigh the future potential against this ongoing dilution. And speaking of the future, that path to profitability. Nomura emphasizes NIO's target for non-GAAP break-even in Q4 2025. What specific upcoming events are really crucial for validating that target? Why are they so pivotal?
There's one event that stands out, NIO Day 2025. It's coming up soon, September 20th. The official launch and, crucially, the pricing of the new ES8 model will happen then.
Yeah.
And immediately after, the locked order data for that model. That will be the real acid test. Those numbers will really show if NIO can hit those very ambitious Q4 sales targets. They're talking 150,000 total units.
Wow, that's 50,000 a month.
Exactly. Hitting that kind of volume is absolutely fundamental to reaching that non-GAAP break-even point they're aiming for. Now, interesting point. Despite this big capital injection, Nomura is sticking with a neutral rating. And their target price is USD 5.00. That's actually below NIO's closing price of USD 6.28 on September 9th. So even with the fresh cash, they remain cautious. What's underpinning that view?
Yeah, that neutral rating signals they're still waiting for more concrete proof, specifically clearer demand validation for the new ES8. Their valuation method is DCF-based discounted cash flow.
Standard approach.
Right. And they're using a WACC, a weighted average cost of capital, of 12.1%. That percentage itself reflects their assessment of the risk involved. They specifically identified downside risks, too. Things like potential hiccups in ramping up production for new models, losing more ground in the EV market share battle, and, the ever-present risk of unexpected supply chain problems. So yes, the capital helps, but these underlying risks keep their outlook tempered, hence the neutral stance.
So pulling it together, this equity raise addresses NIO's immediate balance sheet issues, that deficit situation, But it also really throws into sharp relief just how capital-intensive this high-growth, innovative EV sector truly is.
And maybe here's something for you, our listeners, to consider. NIO keeps returning to the equity markets for funding. They have a clear plan, they're in a critical, future-focused sector, yet they need constant capital injections. What does this repeated reliance tell us about how the risk and valuation paradigms might be shifting for these high-growth, capital-hungry companies? It's a complex picture investors have to navigate.